can see it. So yesterday we were dealing with the measurement of investment property. So I just want to start there before we continue with today. So I'll just go through the last slide that we dealt with yesterday before moving on to what we're going to deal with today. So we said there's recognition and measurement. Recognition is deciding when you're going to record the investment property in the records, and measurement is the value. So we say that there are two models that you can use. You can either use the cost model or you can use the fair value model. And we said with cost model, you'll have accumulated depreciation and accumulated impairment losses, which is like IAS 16, property, plant, and equipment, right? But with the fair value model, there's no depreciation and there's no impairment losses. You just continue to restate annually to the fair value. All right. So we said at initial recognition, if you have investment property that is not under construction, so this is investment property that you bought, all right? So we are saying that for investment property not under construction, assume fair value be reliably measured on a continuing basis unless the market for comparable properties is inactive and alternative reliable measurements of fair value are unavailable. So first of all, you have to look, okay, is there a market? If there's a market and you can determine fair value, you will measure fair value. However, if there's no market and you can't find any alternative measure, then you cannot use the fair value, all right? If investment property had been measured initially at fair value, but subsequently you cannot determine your fair value, you will just use the last known fair value. This is what we discussed yesterday. And we went on to say, let's say at the beginning, on the first date, right, that you obtain the fair value, that's on initial acquisition, you cannot determine the fair value, right? Or if it's at a change of use date. So if you've changed the property from property, plant, and equipment, PPE, to investment property, and you determine on that date that you cannot determine the fair value, you have to account for that property using the cost model, all right? You have to use it, you have to account for that property using the cost model, and you measure it using the cost model until that investment property is disposed. Now for that property, you have to assume a nil residual value, all right? But your other properties may be measured at fair value. All right. What about property that is under construction? Property that is under construction. So always you determine your use of your property, you have to determine your intention, okay? So if at the beginning your intention is to construct that property and you're going to use that property, let's say for rentals, then you're going to classify it as a investment property. So if the entity uses the fair value model and has a property under construction, but a reliable measure of its fair value is currently unavailable, but the entity believes that reliable measure of fair value will be available once construction is complete, then you have to measure it at its cost price. All right? So you can think of it this way. You're building a property, right? You're constructing a property. You don't know at that point in time if there's going to be a reliable measure of fair value. So what are you going to use to determine the value of that property? All right? If you cannot really think that you will be able to measure it at its fair value, then you're just going to use the cost price. So those construction costs that you have, you're going to use. All right? So you use the construction costs. So you measure the investment property at its cost until the fair value becomes available. All right, until the fair value becomes available, or when construction is complete. All right, so you have to look which is earlier. If the fair value becomes available before construction is complete, then you use the fair value. However, if it only becomes available once construction is complete, then you'll only use the fair value once construction is complete. All right. Are there any questions so far? We'll deal with examples to illustrate this. So if your fair value becomes measurable during the construction phase, you have to change the measurement from cost to its fair value. All right, then you'll have a gain or loss on remeasurement. All right, so let's say you're measuring it, you've determined you're using cost. Let's say your cost is 1.5 million. This is during the construction phase. And then eventually you determine a fair value. Let's say your fair value now becomes 1.8 million. At that point in time, you're going to change your measurement basis from the cost model to the fair value model. And that difference between the 1.8 million and the 1.5 million will be recognized as a gain on remeasurement to fair value. We'll deal with this example on page 525 of Gripping Gap. Okay, let me just. Why is my computer freezing? I want to get. All right. This is the example that we're dealing with. I hope you can all see. If you cannot see, then you just have to use your textbooks, if you have your textbooks, or you can just look at the slides for the scenario. Okay, so this example 5, this is the fair value cannot be reliably measured. And this is a building that is purchased, so it's not under construction. You're not building it yourself. All right. So Clueless Limited purchases a building that it intends to hold for capital appreciation. When you see the words capital appreciation, already you determine that it's what? Investment property, right? All right, so if it's for capital appreciation or if it's to earn rentals, it's automatically investment property. The building is purchased on 31 March 20x5 for 1 million. So 1 million is the cost price. On 31 March 20x5, it was unclear if the building's fair value would be reliably measured on a continuing basis. So on the date of acquisition already, it is determined that you won't be able to determine fair value on a continuing basis. Are we together? All right. But then by 31 March 2016 or 20x6, due to a boom in the property industry, the fair value of the building was estimated at 15 million. You're given some other information. The property has an estimated useful life of 20 years. Okay, estimated useful life of 20 years, and the company's accounting policy is to measure the investment property at fair value. Calculate the carrying amount of the property at the year ended 31 March 20x5 and 31 March 20x6. Okay, now what happens here? This is where the theory becomes very important. What does the theory tell us with regard to investment property if at initial acquisition you determine that you will not be able to determine fair value on a continuing basis? What do you have to do with that property? Yes? We have to measure it at its cost price. It doesn't matter if the fair value becomes available later on. Are we together? So we'll always measure that property at its cost. Now, if you look at the cost model, what does the cost model say? Cost minus accumulated depreciation minus accumulated impairment losses. So here we're told that the year end is 31 March 20x5, right? So the year end ends in March. So we are told to calculate the carrying amount at 31 March 20x5 and 31 March 20x6. All right. So what would be the carrying amount at 31 March 20x5? 31 March 20x5, what is carrying amount? Huh? What's the carrying amount? Do you even have to calculate it? All right. So this building was purchased on 31 March. It was purchased at the end of the year already, isn't it? Do you have to account for depreciation on it? No. So the carrying amount on 31 March 20x5 is what? 1 million. Exactly. Carrying amount at 31 March 20x6? Okay. So it's just 1 million divided by 20 years. All right. You're going to get an amount of 50,000, which will be your depreciation. 1 million minus 50,000, you're going to get a carrying amount of 950,000. All right. So I just want to read you the whole answer. Okay. Okay, we'll just start from the solution. This example illustrates the measurement, initial and subsequent, of an investment property where at the time of purchase, clear evidence can be provided that the fair value of the property will probably not be measurable on a continuing basis. Because it was established at acquisition date, this is very important, because it was established at acquisition date that the fair value of the building could not be reliably measured on a continuing basis, IAS 40.53 requires the building be measured under the cost model, all right, throughout its useful life. Cost model is the same for PPE. And that is how we calculated the carrying amount. So and a thing to note, if we're given a residual value in this example, we will not use the residual value because the standard says that we must use a residual value of nil, right? Even if you're given, you might be given a residual value just to confuse you in a test situation. But if at acquisition date you determine that the fair value is not going to be continually estimated, then there's no residual value. The residual value will be nil. All right, so that's very important for you to note because that can trick you up in a test situation. All right, so I was saying if you're going to calculate depreciation on this property, since we're using the cost model, right? And if you're given a residual value, you should not use that residual value because the standard tells us that you must assume a residual value of nil. You must assume a residual value of 0. So your residual value would be 0. All right, that's what the standard says. And the reason for that, you can think of it this way. If you cannot determine the fair value, how will you determine the price that this asset would be sold for at its end of its useful life if you cannot even determine what it's worth? All right, so think of it in that way. So if you cannot determine the fair value, then obviously you will not also, you can think of it that you will not be able to determine the residual value. So the residual value should be nil. All right, I just want to read the rest of the comments. Now in this example, we're given a fair value in 20x6. So that was after initial acquisition. We're given a fair value for 20x6 that the amount was 15 million. So what is the rationale for excluding that fair value? Even though the fair value can be measured at the next financial year end, the building must remain at depreciated cost, historical cost, and must never be revalued to its fair value. Okay, so when we're forced to use the cost model, then depreciation must be calculated using a new residual value, even if the entity estimates another amount of the residual value. So that already explained. All right. Any questions? Okay. It seems okay. Yes. The residual value will, or in most instances, be given to you. You won't be told to calculate a residual value. You'll always be given a residual value. All right. So, yeah, if you're not given, then you assume a residual value of nil. Let me go back to the slide so that we can. So we've dealt with this example. That's example 3. Okay. Example 4. You should always go back through these examples on your own, right? In addition to the tutorial questions that you're given. Oh, okay. You can pass it here as well. All right. Now this example 4 deals with the fair value model. You have C Limited owns an investment property which is accounted for in terms of the fair value model. The following applies. The cost price of the property on 1st of January 2015 is 5 million. It was financed 100% through a mortgage loan, and you paid some legal costs of 100,000. Your fair value at 31 December 2015 is 5.3 million, while your fair value at 31 December 2016 is 4.8 million. Recognize, provide the journal entries to account for this property. Provide the journal entries to account for this investment property. So the journal entries, not only, I didn't say provide the journal entries at the end of the year, even if I say for the year ended, you have to provide all the journal entries. So the first journal entry will be the one at acquisition date, and then you're going to provide the journal entries at 31 December 2015 and at 31 December 2016. I'm going to give you 3 minutes to do this example on your own. Just prepare the journal entries on your own, and then we will talk about it. So it's 9:55 right now, so at 9:58, I will need the solution from you. Provide the journal entries to account for the investment property. Three minutes to do this on your own. The first one is at 1st of January 2015, then 31 December 2015. moments. Time management is very important, especially in a test situation. Time management is very, very important. You must ensure you have a calculator for your test situation. In a test situation, you cannot use your phone in a test. You must always use calculators. Okay, are we done? No. It should be done. This is too slow. In a test situation, you will not finish. You will not finish in a test situation. I said I will come back at what? 9:58. It's almost 10 o'clock now. I gave you extra time. All right. So let us look at this. I was going around just to check what you were doing. And so one thing I noticed, some of you are saying debit PPE. PPE is a whole different standard, right? PPE is IAS 16, so this is not PPE, it's investment property. It's investment property. So your first journal entry, what would your first journal entry be? Debit investment property with what amount? Okay, who says 5 million? Can you raise up your hands? 1, 2, 3, 4, 5. Some of you are unsure. All right. Who says 5,100,000? Okay. 5,100,000. All right. There are fewer people who say 5,100,000 and some say 5 million. Remember investment property at cost, price including transaction costs. So in order to acquire this investment property, you had legal fees as well, right? So your total value of your investment property is 5.1 million. The cost price plus the legal costs that were paid through cash. All right. So debit investment property 5.1 million. Then credit your bank 100,000. Now this is important because this tells us that the legal costs were paid through cash. When you see cash, we just use the bank account, right? No one is going to pay 100,000 in cash unless you want to be robbed. All right. So this will probably go through the bank account. And then the other part was the loan, the mortgage loan of 5 million. All right. So the 3 zeros were not included, but it's shown at the top there. That's in thousands. So you just have to multiply this by thousands to get the whole amount. All right. So this is 5.1 million, 100,000, and 5 million. Now let us look at the journal entry 31 December 2015. The fair value of the property rises to 5.3 million. All right, the fair value rises to 5.3 million. But what was it when we bought it? It was worth 5.1 million, isn't it? So it has increased in value. So the investment property has increased in value. So obviously we're going to debit the investment property. So this is SFP. Here they just put FP, but that's SFP, Statement of Financial Position. So I just recommend you write the whole SFP for Statement of Financial Position, okay? What do you credit? What do you credit? You wanted to say something? Profit on remeasurement. Okay. Anyone else? Anyone else? Yes? Okay. Why not revaluation surplus? Okay. So that's a good question. Why not revaluation surplus? Revaluation surplus relates to PPE. And a revaluation surplus is totally different than a remeasurement to fair value. So what did we say revaluation surplus is? It's when the property is increasing in value, but it relates specifically to PPE. This is property that you're going to use either in the manufacturing property or process, or if you're going to use, let's say, for administrative purposes, isn't it? This is not property that you're going to use for capital appreciation or to rent out. So the classification is different. And then any revaluation surplus is remeasured in other comprehensive income, right? Any valuation surplus is measured in other comprehensive income. So in this standard IAS 40, it tells us if we have a gain or loss on remeasurement of investment property, that goes to your profit or loss account. All right, so the treatment for investment property is different from the treatment of property, plant, and equipment. If this was property, plant, and equipment, you would credit your revaluation surplus, OCI, other comprehensive income. All right, but it's not that. This is now investment property. You can say gain on remeasurement to fair value. That's the account that you credit. Your gain on remeasurement to fair value. You just have to write it down. Okay, your gain, that's a gain on remeasurement to fair value. And the gain on remeasurement to fair value will appear in your statement of profit or loss. So in brackets, you put SPL to indicate that is statement of profit or loss. Your narration, okay, I didn't say your narration. You just say remeasurement to fair value or recognition of gain on remeasurement to fair value. So once this property, now at this date, the property plant, the investment property will be valued at 5.3 million, isn't it? All right. But it tells you now at 31 December 2016, it's now measured at 4.8 million. 4.8 million, it has gone down, isn't it? It has gone down by how much? 500,000. So now what is your journal entry? You have to reduce the value of your property, investment property. What you do? Yes? Credit your investment property. Okay. Credit your investment property and debit your loss on remeasurement to fair value. All right. So this one will be, you're going to debit your loss on remeasurement to fair value. And that appears in your statement of profit or loss. So you put SPL in brackets. All right. Any questions? Do you have any questions for me? Seems there are no questions. Sorry, I just wanted to see the time. Okay. Let us move on. So this deals with measurements, how we're going to measure investment property. Now it can happen that you have a change of use of the property. So investment property doesn't always have to remain investment property. It can change to become PPE, isn't it? Or PPE, you can decide, no, we don't need this administration building anymore. Let us rent it out. So PPE can change to become investment property. So now the standard gives us criteria, what you should do when you deal with a change of use. So a change of use is basically a change in classification of that particular item of property, that land or that building. So the issue that we're going to look at is, when should a change of use be recognized? All right, so this deals with recognition. And at what value should the transfer be recognized? That deals with measurement. All right, so we're going to deal with the recognition and measurement. Now, can you just do a change of use at any time? How would you decide to do a change of use? So can you just decide 1 year that you're going to change the classification? This is an issue that also became a problem. I think it was for Trustco when they were reporting their results. So they had some, I think they classified some property as inventory because they were developing, and for developers, if you selling property, buying and selling, you can classify it as inventory. And then they changed it to, I think it was changed to investment property or something like that. I'm not too sure what they changed to, but then it became an issue from with particularly the Johannesburg Stock Exchange, because Trustco is also listed on the Johannesburg Stock Exchange. They were not happy with the classifications of accounts, and Trustco showed a huge profit because of just a change in classification, when in actual fact they'd been making huge losses. All right. So this change of classification, you can't just decide, okay, maybe our books need to look better, we need to make a profit, and then you just change your classification. So let us look at it. When can you do it? There must be clear evidence that a transfer has taken place. So either you've changed it from PPE to investment property, or from inventories to investment property, or from investment property to inventories, etc. So there must be clear evidence that the transaction has taken, or that the transfer has taken place, and management's intention of a transfer is not clear evidence of a change of use. Just because management says we want to do it, that's the intention to do it, that is not clear evidence. All right. All right, so there must be clear evidence. So the question will tell you that there was clear evidence that it was going to be used. So if you look at it, let us say you're changing investment properties to become inventories. Now you want to become a dealer or trader in properties, right? Then maybe you've registered to sell those buildings, and you've actually even sold some buildings. That is actually evidence that, okay, no, now these buildings are actually being sold, all right? And you're using them as inventories, because now your mode of business has actually changed. There has to be clear evidence of that. All right. So let us look at it. Investment property can change to become owner-occupied property or inventory. I wish you could see everything here. All right. Investment property can change to become owner-occupied property or inventory. Owner-occupied property means it's PPE. So property that you decided you wanted to rent out, or you were renting out in the past, now you decide to use it as your head office, for instance, right? So that is changing investment property to become PPE. Or you change that property and you decide, okay, instead of keeping all of these properties for rentals, let us now change and sell these properties. And then you become a trader in property, so that investment property now becomes inventory. All right, so we haven't dealt with inventory up to now, but we will be dealing with it. So when does investment property cease to be classified as investment property? When the investment property becomes owner occupied, so let us say you move into into those buildings. So that is clear evidence. You are renting out this property. Now you've told the tenants, listen, at the end of the month, you need to move out because we want to move in. Now the tenants move out, and then you now bring your whole office and you start operating from that building that was previously rented out. That is clear evidence, isn't it? Right? Now you've transferred it from renting it out, and so now it becomes PPE. Yes, you can go ahead.
What if it was owner-occupied property and then they take a section we are building and rent it out.
Okay, yes, it can happen like that. So remember, we talked about joint use. All right, so joint use, you have to look at the proportion. If a significant portion is rented out, then maybe you have to now classify it as investment property. If it's only like a small portion that is classified, then you can just use it as PPE. So it depends, all right? You have to look at what the question says. All right. So investment property can also become inventories. When investment property becomes available for sale in the ordinary course of business. So this business has now changed activities to like trading in buildings. All right. So let's just look at an example. Construction or development with a view to make investment property saleable should have begun. If there's no evidence of construction or development, then you must continue to classify as investment property. All right. So inventory, we know inventory. It's goods that are bought for the purpose of resale. That is when we're thinking of normal goods. But if you're a developer, you can construct buildings with the purpose of selling them, right? So you can construct buildings with the purpose of renting them out, or you can construct buildings with the purpose of selling them. All right. So if you're now constructing buildings with the purpose of selling them, then it's investment. It is inventories. All right. So this has to be the sale in the ordinary course of business, because it can happen that you have an asset, let's say a building, that you're going to sell, right? But it's going to be classified in terms of non-current assets held for sale. This is because it's maybe not your business activities, buying and selling inventories. So let us say NUST as a portion of a building that it wants to sell. Now, does NUST usually deal with buying and selling buildings? It doesn't. So if NUST wants to sell a building, that property would be classified as a non-current asset held for sale. But if it's NUST was a developer and it's in the ordinary course of business that they sell buildings, then it could change from, in this instance, investment property to inventory. All right. However, changes can happen the other way around. Owner-occupied property can become inventory or owner-occupied property or inventory may become investment property. So when does owner-occupied property or inventory become classified as investment property? So when a previous owner-occupied property ceases to be owned by the owners and becomes rented out under an operating lease. All right, so a property that you were in, you decide, okay, no, let us move out. Maybe you need bigger premises. So for example, we know FNB had a head office in town, right? And then they moved just not far to another head office there near Slowtown, Hilton. Yeah, all right. So they moved there. So let us say that old building, they own that old building, and now they decide to rent it out. That is an example of owner-occupied property now changing to become investment property. Are we together? All right. You might have a situation when property that is held for resale now becomes rented out, all right, under an operating lease. So this happens usually, you can see like in the markets where, like now there's a kind of a downward market in the property market, whereby people are trying to sell their properties, but because of the way the economy is, this whole COVID that took effect, people really don't have that income and they're not getting much buyers, right? So instead of leaving the property empty, or because they're not getting any sales, no one wants to buy it, they might decide, okay, let us rent out this property, isn't it? All right, so that property now changes from being held for sale in the ordinary course of building, and it becomes investment property. All right, because now it's held with the view to earn rentals. All right. Okay. So, example of change of use, we'll deal with this example in gripping up for page 527. Let us look at this. This is the last example that we're going to deal with. So this is just a discussion question. We haven't dealt with measurement yet because the standard gives us issues surrounding measurement, how you're going to measure the property. All right. So let us look at this. Transfers in and out of investment property. Pillow Limited was in the process of constructing a building to be used to earn rental income. When due to financial difficulties, it could not complete the construction thereof. So at the beginning, this company, Pillow Limited, is constructing buildings. They want to use these buildings to rent it out. So they've already decided to classify it as what? They've decided to classify it as investment property. Construction is now not finished. So the required, explain how Pillow Limited should account for the building if its intention is now to sell the building as is. And it tells us that Pillow Limited sometimes sells buildings as part of its business activities. All right. So they could not complete the construction, right? So scenario A tells us, fine, they leave it as it is and they decide to sell it. But we're also told that Pillow Limited sometimes sells business as buildings as part of its ordinary business activities. What happens here? What happens here? We just went through the theory. All right. So always before doing an example, you have to grasp the theory. All right, we have to grasp the theory. Let us go in. So this is the example that is relevant to us. Investment property ceases to become investment property. All right, so this is the second bullet here. When investment property becomes for sale in the ordinary course of business. When does it? So when it becomes for sale in the ordinary course of business, it should be classified as inventory. But we are told that construction or development with the view to making investment properties saleable should have begun. If there is no evidence of construction or development, continue to classify as investment property. So in this instance, we are told that they had difficulties and they stopped, right, with the construction. But this one tells us if you want to classify it as inventory, there must be construction or development that takes place in order to make the building saleable. So the scenario guides us here. For A, it tells us sell the building as it is. Pillow Limited sometimes sells the buildings as part of its business activities. All right. So let us read. Whilst the property was being developed, it should be classified as investment property since the entity's intention was to earn rental income from the property. That we all knew, right? It was classified as investment property. However, the recent turn of events and change in intention will result in the following accounting treatment going forward. So let's look at A. The change in use suggests that there should be a transfer out of investment property. All right? Since it is no longer held for rental income, but it is now to be sold as part of its ordinary activities. All right, so we think, all right, we should change it. However, IAS 40 clarifies that a change in use cannot be based purely on management intention. And thus, a transfer to investment property can only occur if there is a change in use evidenced by commencement of development with a view to sale, right? So if there is a change in use evidenced by commencement of development with a view to sale. So in this thing, they told us that they're selling it as is. So there's no evidence that they have made any progress or advancements to make it saleable. All right. So in this instance, the investment property should remain classified as investment property. Are we together? All right. Let us deal with B, and then the last one you deal with. You will look at it at your own. Hold the building as is for capital appreciation. Okay. Okay, this one is straightforward. Hold the building for capital appreciation. If the intention is to keep the building for capital appreciation, the building remains classified as investment property because it still meets the definition of investment property, because that was the original classification, isn't it? And they're still continuing with that. Pillar will then now have the option to measure it under the fair value model, which is preferred by IAS 40, or the cost model. All right, so that is not relevant to us. They didn't ask us to discuss measurement. All right, but this type of question gives you, it really breaks it down so that you have your understanding. Okay, let's just deal with the last one. 2 minutes. Borrow from the bank. The last option is to borrow from the bank and complete the building, then use it as the entity's head office. Okay, so you wanted to say something? Oh, no? Okay, we can just read it because time is up. If there's sufficient evidence that the intention is to borrow from the bank and complete the building for future owner occupation, the building will no longer meet the investment property definition and would instead meet the property, plant and equipment definition. It will thus be transferred to property, plant and equipment. Borrowing costs must be capitalized if the building is a qualifying asset. If it is not a qualifying asset, the borrowing cost must be expensed. All right, as I mentioned before, we're not dealing with borrowing costs, so you don't have to look at that standard IAS 23 that deals with borrowing costs. All right, so all I have to announce is that test is on Friday. Time management is very important. Prior year tests are on e-learning with their solutions, right? So go through that, try and do it maybe from today, try and do it out under exam conditions, because most of the people do not finish. All right, so that is an important thing, time management. Good luck in your test and see you next week, Tuesday.